Welcome everyone to the webinar today. Thanks for joining us, and I'd also like to welcome our Mortgage Choice Amplify and Connective Elevate partners. My name is Tony MacRae. I'm the Chief Commercial Officer for Bluestone, and I'm really excited to be hosting today's webinar along with Tim Lawless from Cotality. Today, amongst other things, we'll cover what's happening to home values post the February and most recent rate cuts, the buy-sell dynamics in today's market, the ongoing housing supply challenge, and various macro trends to watch with upside risks and downside risks. I just remind everyone, if you do have a question, please type them in the Q&A section in Teams, and we'll answer these throughout. There'll also be one CPD point for attending today's session, which you will receive after the webinar, and we'll also be posting a copy of today's session. Now, let me introduce today's guest, Tim Lawless. Tim's widely regarded as one of Australia's leading property market analysts and commentators by business and the media. He brings more than 20 years' experience to the role, providing deep insights and analysis on national housing trends. Tim's expertise across property markets has positioned him as one of the country's most experienced and popular property market analysts and commentators. And as always, it's an absolute pleasure to have Tim join us and catch up with him. Welcome, Tim.
Many thanks, Tony. It's always a pleasure, these webinars, and certainly look forward to the Q&A that comes through towards the end as well.
Absolutely, and I'm sure in the environment that we've got at the moment, both locally and internationally, there is just a whole heap of things happening, and there will be plenty of questions.
Mate, there are so many moving parts, aren't there? I mean, we've got rates are coming down, inflation's back in the target zone, but we've also got these headwinds around, as you mentioned, a lot of global uncertainty. Liberation Day certainly threw a spanner in the works, and now we're seeing a lot more in the way of conflict in the Middle East. So, yeah, I think it's certainly some complexity under the surface.
It's certainly never a dull moment, and interesting times, but also exciting times, particularly in the property market. So probably a good place for us to start is just be great to get just a general update on what is happening with property values and here in the local markets in Australia.
Well, let's start at the top, I guess, Tony, and as usual, I'll share a few slides, and for everyone's benefit, this is being recorded, and no doubt you'll get a copy. But yeah, at a really macro level, we're seeing some really interesting trends. As rates have come down, it's created this positive inflection for housing markets. We're seeing a lot more uniformity in the trends now. We've moved through this period of extreme diversity to now seeing one where the mid-sized capitals are slowing down a little bit. Some of the softer markets like Melbourne and Hobart are moving back into growth. And we're also seeing some very different regional trends as well. So maybe a good place to start, Tony, is just on that national trend. I think this is a really good scene setter, and people who have joined the webinar in the past will be familiar with this graph. It's a national one, and each one of these columns represents a month of change, National Home Value Index. And it just highlights this positive inflection that I was just talking about. Coming into late last year and through to January this year, the market had clearly flattened out. In fact, it recorded a very subtle decline. Our index was down about 0.4% over that 3-month period. But then February happened. We saw a rate cut. We saw sentiment improve, and the market responded quite positively. And since then, we've seen four months of growth. Definitely not shooting the lights out. This isn't a significant rise in values, but it is broad-based, and you can see every capital city is now moving back into a growth trend. This is the rolling quarterly change, and it just highlights that even some of the softer markets like the ACT, Melbourne's kind of middle of the pack now after being quite a weak market for a couple of years. Darwin seems to be running its own race. An extraordinarily affordable market that has very high investment yields, does seem to be becoming more attractive to investors, but I mean, it is such a small market, it doesn't really move the headline numbers around. But a better way to look at I guess, the diversity we've been through in the market is to look at the annual change. And this is where this convergence that I was talking about is becoming really clear. You can see what I meant about those mid-sized capitals, Perth, Adelaide, Brisbane, are losing some momentum. And that's on the back of things like just affordability becoming more challenging. Net interstate migration has slowed in these markets. It's gone negative in Adelaide. And we've also seen less investment activity, still relatively high, but a slowing level of investment activity. Whereas at the other end of the spectrum, you can start to see the turn that Melbourne's moving through. Still negative on an annual basis, but as I mentioned, it's up over the past quarter, it's up over the year to date, so is the ACT. And that diversity that we're just talking about, I mean, it was only August last year. We're moving through the most diverse conditions in annual growth rates that we'd seen since 2007, which was pretty much around the height of the mining boom. You can see it on the graph here. We had about a 26 percentage point difference between the top performing capital city in August last year, that was Perth, and the worst performing city, which was Hobart, which was down a couple of percentage points. Now we're in a market where that range in the annual growth rates has reduced to sub 10 percentage points. It's the narrowest range we've seen since early 2021. So it gives you a bit of a mathematical feel for this narrowing of the gap between the top and the bottom performers. But of course, over the medium term, Tony, there's been such a radical difference in the growth outcomes across each of the housing markets. You got Melbourne, past 5 years, housing values are up about 13%. Quite politely a sustainable rate of growth, if you could just looking for something positive. But in markets like Perth, Adelaide, Brisbane, we've seen housing values rise by more than 70% in 5 years. It's a lot of the growth drivers, for example, in those mid-sized capitals have been things like just it came into this cycle from a very weak perspective. Generally, housing was very affordable in 2020 in each of those three capitals. Strong rates of interstate migration, much higher levels of investment, where it's pretty much the opposite for Melbourne. Melbourne had come into 2020. Sure, we saw a bit of a correction between 2017 and 2020, so there was a bit of an affordability improvement. But Melbourne simply hasn't seen the same sort of demographic factors that have supported housing demand. Melbourne's delivered a lot more supply over the medium term as well. That's a pretty good case study on how a healthy level of housing supply can help to keep a lid on affordability. And more recently, of course, there's been things that have disincentivized investments in Victoria, particularly the lowering of the threshold for land tax, higher rates of stamp duty, which really have disincentivized investment in that market. So the wash up of that 5-year trend is there's been this real shuffling of values across the markets. You've still got Sydney standing out as an extreme premium above all the other capitals, but Melbourne, on the back of such a weak growth run, is now the only cities that are more affordable, at least on a median value terms, than Melbourne is Hobart and Darwin. Brisbane, second highest median value, Adelaide and Perth. We haven't seen those two cities tracking above Melbourne in their median value, or Adelaide, since forever. Perth, you'd have to go all the way back to the mining boom. So a real, changing of the guard, if you will, across the markets. And a lot of that growth has been very much centered around what you might describe as the more affordable areas of each of these markets. These maps just look at the annual change in housing values across each of the suburbs of these major cities. Melbourne's a good example, right? It's a city where 60% of suburbs have recorded a decline in values over the past 12 months. But there are some examples of growth, and they tend to be around those more outer fringe greenfield markets. You can see Frankston and Dandenong are really clear examples, or getting out towards the west, Melton and Wyndham, or even in Sydney, another really good example of this trend where it's the premium markets that have seen softer conditions, but getting out west towards the more mortgage belts and the affordable regions, there has been some growth, even some suburbs seeing more than 10% gains over the past 12 months. And to a lesser extent, you can see that in the mid-sized capitals, where it's the outer fringes that have generally driven stronger rates of capital gain. And finally, just touching on the regions, Tony, we are again seeing a convergence of growth rates here. Not necessarily because regional markets are slowing down. It's more about the capital cities accelerating in their growth trends, getting a bit closer to where the regions have been over the past year or so. And as I mentioned a bit earlier on, the trends across regional Australia are very different to what they were through the pandemic. You've got the best performing regional markets tend to be a lot more rural in nature, like Townsville is a great example of a heavily diversified regional market. It's quite affordable. It's got a median value of around 550,000. And a lot of these examples in the top 30 list, each of the grey areas are regional markets, are exactly the same. They have their own economic microcosm. They tend to be a fairly affordable market, and they're quite different. I mean, the pandemic was more about commutable markets and lifestyle regions, whereas now the strongest conditions really do seem to be a little bit more far flung. So it's trying to wrap up the dynamic across the market in a short space of time is becoming harder and harder, I think, mate, just given this complexity that we're seeing, and there's so many moving parts. But overall, we're looking at a fairly broad-based but moderate growth pattern around most regions of Australia.
And do you see that as sustainable, Tim, or is there something else going on in the dynamics there that are driving it?
Yeah, I think I probably wouldn't use the term sustainable for every market, right? Think about somewhere like Adelaide is a really good example of a city that's been through what about 75% growth in 5 years. Sure, it started from a low base, but it's now a city when you adjust for local incomes where affordability is pretty close to Sydney's in terms of its unaffordability. It's got a negative rate of interstate migration. I think one of the only reasons we're seeing some further growth in a market like Adelaide is simply because supply is extraordinarily low, particularly listing numbers, and that will eventually change. So I think when we look at markets like Southeast Queensland or Perth, that growth rate is now I describe as much more sustainable. We're no longer seeing 20% plus annual growth rates in those markets. And at the other end of the spectrum, somewhere like Melbourne, where we're still seeing a negative annual growth rate and a monthly rate of change that's now sort of moving into the 0.4s, 0.5s. I think, yeah, absolutely, that is sustainable against a backdrop of Melbourne being a reasonably affordable market now, and also starting to see positive interstate migration coming through, a little bit more investment attention as well. So, yeah, I think it is sustainable, but with a few exceptions there that, I think the risk rating on markets like Adelaide would probably be a little bit higher now, given its unaffordability and lack of population growth.
Um, Reflecting on one of your earlier charts, that it's albeit only for a quarter or so, but it's the first time for quite some time that we've seen all capitals in the positive growth phase. Is that being driven through buying or selling activity, that dynamic?
Yeah, a bit of both. And we've definitely seen some evidence that selling activity is picking up. I've got a few graphs here just on what we're seeing in terms of transactional activity. I mean, I would definitely, again, I wouldn't say this shooting the lights out. We're seeing transactional activity that's getting back to about average levels because there are still quite a few, I guess, barriers to homes selling, right? You've got things like affordability, low sentiment, generally conservative lending environments, um, uh, um, as well as some of the I guess the confidence issues we've seen emerging from the tariff discussions and global conflict. So these graphs look at just the month-on-month number of home sales. There's a bit of a word of caution here. These numbers generally do tend to revise upwards a little bit, so maybe it's a conservative view, but if you look at the trend prior to the most recent month, we're generally seeing home sales tracking at around about that 5-year average. So definitely not shooting the lights out, not as strong as what they were, say, back in the second half of 2023 or into 2024. But also, there's been a lot of disruption the last couple of months around, the lot of longer weekends, which I'm certainly not complaining about. Easter, that type of stuff has been quite disruptive. When you look at the transactional trends on a more sort of smoothed out or long running basis, you can see that we haven't seen anywhere near the number of home sales as what we have been or what we saw through the pandemic. it's well down on those peak levels. It's a really good reminder that there's a lot of other things that drive transactional activity in the market. A lot of people would point towards population growth as, a proxy for housing demand, and fair enough, it is. But through the pandemic, that was a time when we had closed international borders and overseas migration was negative. Yet we saw nearly a record number of home sales in the marketplace. It's a reminder of the pent-up demand we saw accrue through the previous downturn and the macro-prudential phase and the Royal Commission, as well as the fact that very low interest rates really unlocked a lot of that demand. So even though we've seen transactional activity moving higher through 23 and 24, it certainly didn't get to those frothy highs, and I'd certainly wouldn't expect the fall in activity to get down as low as what it did in early 2023. I'd expect it to remain a little bit above that decade average, just simply due to the fact that there's going to be some upwards pressure on sales from low interest rates or lower interest rates, and improved serviceability, as well as the associated confidence boost you get from lower inflation and lower interest rates as well tends to support housing activity. But like I said, I think there's still going to be some barriers in front of us, Tony. Probably the most significant one is simply affordability. These are the macro sort of views on housing affordability across Australia at the end of last year, at least. Each one of these is either at a record high or equal record high. There'll be a little bit of improvement in that second graph, the percent of income required to service a new mortgage. That'll come down a little bit now that we've seen interest rates coming down. But still, I mean, from 50% down to probably around the mid to low 40s is still a pretty high serviceability ratio. If you're on the median income, you're probably still looking around that lower quartile of the market, which is where you'll be able to access credit. Lower population growth is another sort of factor that's probably going to stymie demand a little bit, but I think mostly this will show up in less rental demand. We're already seeing that, although vacancy rates are still pretty tight. And then you've got just the sentiment factor. And my guess is if you look at the monthly sentiment readings, they've been a little bit jumpy, but there has been an upwards trend in sentiment. It jumped pretty well in March after the February rate cut, then it fell back a little bit on Liberation Day tariff announcements and some of the conflict we're seeing, particularly around the Middle East. But my guess is interest rates come down further, which absolutely I'm expecting will happen. You'll probably find sentiment lifts further, and if history is anything to go by, you'll probably see that flowing through to an improvement in transactional activity. And that's also at a time, Tony, when listings are coming down a little bit as well. So listings are coming down partly due to the fact that vendor activity has been pretty mild. You can see that in the graph on the left, where new listings, they're tracking about 9% lower than a year ago. They're about 4% below the 5-year average. So in some ways, vendors are kind of sitting on their hands to some extent, but total listings are also coming down. They're about 13% below the 5-year average now. So I think with those shorter supply levels, you probably will find a little bit of urgency returning to the market, especially in these areas where there's a clear downwards trajectory in listing numbers. I mean, Melbourne's a really good example, right? We're now finally seeing listings are falling down to below or roughly equal to the 5-year average. I think they'll probably drop below the 5-year average. Hobart, which has been a really soft market, you're seeing a plummet in listing numbers from really high levels. And even those mid-sized capitals are still seeing very low listing numbers. Sydney's a bit of an exception. We're still seeing Sydney listing numbers elevated. And again, there's quite a few barriers in that marketplace around an affordability perspective. But it does look like vendors have been pretty light on the ground as well, which in itself probably helps to keep supply levels relatively low, which means that selling conditions have gotten a little bit better. Look at clearance rates. They're a little bit above average now. Remember last year, they were sort of plumbing that sort of mid 50% range. Now they're back up to the mid 60% range, a little bit above the 5-year average, and definitely showing a better balance between buyers and sellers when it comes to auctions, as well as a lot of the private treaty metrics. We're no longer seeing time on market lifting, vendor discounting, which is negotiation in the market. Looks to be starting to level out a little bit as well now, Tony. So, yeah, a long answer to your question about what's driving the market. It's a combination of a subtle fall in listing numbers, transactional activity lifting back to around average levels as well.
I'm keen to jump into the supply side, but before we do, we've in previous webinars we've spoken and commented on high migrate or immigration numbers, but you've made the valid point that actually that it drives the rental market in the short term, as most people spend a couple of years renting before they buy when they move to Australia. Given that we've the last 2 years we've seen record high immigration, is there a risk that we're about to hit another wave of big demand coming through, Tim? And with interest rates coming down, affordability in many places improving, are we at risk of a bubble?
No, I don't think so, Tony. And this is just a refresher on the population growth numbers, right? So, yeah, we've been through this absolute boom in population growth, mostly driven by net overseas migration, which is now pretty much normalized. But it came after a period where overseas migration plummeted for obvious reasons. So a lot of this was catch up. If you look at the underlying dynamic of who comprises these net overseas migrants, roughly 80% of them are here temporarily. They're typically students, they're here on short-term temporary visas. And a lot of those arrivals that surged into the market and peaked in the first quarter of 2023, they're now moving into an expiry as well. So you have fewer migrants coming to Australia, more probably leaving, hence this rationalization of the trends. By the way, we'll see an update on these. These numbers are really lagged, right? We're looking at September data here. We'll see an update to the December data on Thursday. So if anybody's interested in the demographic trends, that's one to watch out for. But my guess is the net overseas migration data is going to be stabilizing around that long run average. Definitely nothing like what we've seen in the past. So remember, we also haven't built much. A good segue to a talk about housing supply. We haven't built much. So there is this accrued undersupply that's going to play out for some time yet, I think, Tony.
So I'm keen to explore the supply side there, and are we can we expect to see a pickup in construction, and also just we've got a new norm in construction costs, and what your outlook on that front is, Tim.
Okay, so supply is, I think, on the tip of every politician's tongue, right? It's something that's going to be really hard to fix. Everybody acknowledges we have in sort of strong language, a housing supply crisis. Even though we're now seeing population growth coming down, we just simply haven't seen a necessary supply response at a time when we saw an influx of migrants and very strong population growth to Australia. So just as a little bit of context, the federal government has a pretty aggressive target, right? A 1.2 million well-located homes target in 5 years. That 5-year period is up to July 2029. So everyone acknowledges that's going to be, well, impossible. Nothing's impossible, but it's going to be really hard to get there. The National Housing Supply Council put out their report earlier this year. They reckon we'll probably get to around 950,000. So a pretty decent shortfall on this target. And I'll talk about some of the reasons why, right? So, I mean, we've already started to see a pickup in approvals. That's great news. That's the graph on the right-hand side there. But that seems to be stalling now. So we saw approvals rising off a very low base. They got roughly to the 10-year average, didn't get anywhere near the 20,000 a month. That's what we need to see to hit that accord target of 1.2 million. Now they've come back a little bit, which is mostly the volatility in the multi-unit sector that's creating some of the noise there. But if you look across the states, the areas where dwelling approvals have been a little bit better are generally the markets that have seen stronger housing conditions. These are probably areas where it's a little bit more straightforward to demonstrate a feasibility to get product into the marketplace. There are also markets that tend to be a lot more dominated by low density detached housing rather than multi-unit housing. So South Australia, Western Australia are the two best examples. Queensland, to a lesser extent, Vic was sort of bobbing around that 10-year average for a little bit. But look at somewhere like, New South Wales has been tracking way below that 10-year average for a long time. Tassie is still heading south. The ACT's had a pretty decent supply response over the medium term, but is now looking pretty shabby. And then once you progress to the next step, right, the approvals is really early in the building process. Then you go to a commencement data, which is quite different, right? And again, it highlights this, I guess, trend towards detached housing being more practical to deliver at the moment. Remember, if you're facing feasibility challenges as a developer, at least in the greenfield sector, you can cut up your block sizes a bit smaller to try and derive a yield or a profit. But look at the multi-unit sector commencements trends. It's looking pretty woeful to me and not really showing any signs of turning around. This is the sector where construction costs have gone up a lot more. It's where there's a lot of competition for trades with the big infrastructure sector as well. And I think this is generally that medium to high density sector is where a lot of state governments are trying to focus their initiatives to get more infill supply into the market. But the reality is, it's just not profitable to do so for the private sector. So I think when we look at some of the challenges going forward for housing supply, these are going to be ongoing. We know that construction costs are still rising. Even though they're not rising anywhere near as quickly as they used to be, they're not going backwards. And a bit of a sneak peek on our June data, I think just chatting to our costings team and monitoring what the inputs look like, we're probably going to see a bounce back in the June quarter construction cost index, maybe to around 1%, maybe a bit less than that. But what's really driving the upwards pressure on costs now is more around labor rather than input costs. So you can see the input costs off to the right. They've generally eased off in their rate of growth or even gone backwards, like in the case of steel and steel products, much less upwards pressure on structural timbers and that type of thing as well. But look at competition with the big infrastructure sector. This is a graph from the Infrastructure Australia dashboard. Really, really useful tool if anybody's interested in these trends. And they're suggesting that we probably won't see a peak in demand for labor in the infrastructure sector till about maybe mid 2026, 2027, and then a gradual easing. My guess is it's going to be a lot longer than that, given most of these big infrastructure projects tend to run over time and over cost. I don't think we'll see a crossover in supply and demand for labor supply, probably till well after 2028, given how many projects there are and this ongoing competition and the overruns. So the unfortunate reality, I think, Tony, is that housing supply in Australia is facing a real challenge from a costing perspective, from a labor scarcity perspective. And despite the best intentions, or a lot of policy that's trying to support construction, we're not going to see the private sector really lifting heavy into the supply space until we see some ability to draw profit from new building activity. I think that's a long way off.
And do you see that high density is the pathway to hit that 1.2, or is there an alternative pathway, Tim?
It's probably more what a lot of town planners would describe as soft density, I think, Tony. So infill targets, really capitalizing on densification along transport spines. Got to remember, there's a lot of infrastructure investment underway at the moment. Some really high-profile projects. The metro in Sydney is a great example. Some of the big infrastructure improvements around southeast Queensland, the Melbourne metro as well. Freeway expansions, all these massive projects, you're typically going to see the government looking to leverage their capital investment into these projects by densifying along those transport spines. And logically, it's going to be some sort of medium to high density style of infrastructure, say around train stations. But also, these are unfortunately the same sort of projects that just simply seem to be unfeasible to build. For a developer to sort of build that type of stock and then sell it into the marketplace for a profit margin that's acceptable, they're competing with the established market that isn't quite at that same level. And I don't think consumers are going to be willing to pay the premium that they need to, which makes the feasibility for delivering that stock to the marketplace really hard. So at the moment, as the commencements data showed, there's a real bias towards detached greenfield styles of housing. It's a little bit easier to get that into the marketplace. maybe a bit easier to get through the town planning process as well. From a multi-unit perspective, there are a few exceptions, like the build-to-rent sector is really sort of gathering some pace, especially in Melbourne. You've got sort of a boutique-style high-end apartments. That seems to be where feasibilities can actually deliver a profit to developers as well. So I wouldn't say it's a blanket, but more your mainstream slash investor style of stock is, I think, where developers are really going to struggle to find a price point that's palatable for them, but also where consumers are going to pay that sort of price.
Yeah, I'll just remind participants if you do have a question of Tim, please use the Q&A section of Teams, and we'll certainly get to those. So Tim, you're sort of painting a bit of a mixed picture. There's some positives and green shoots there, but there's certainly still some headwinds. In general sense, broader macro trends that you're seeing in the market. What are you seeing there?
There's definitely a few things to be watching for, Tony, and most of these sort of macroeconomic perspectives are the sort of things that the RBA is going to be writing a lot about, and you'll see a lot of the banking sector economists talking about as well. They're generally looking much more positive, right? So inflation's back in the target range and expected to reduce further. We're seeing the unemployment rate is very low, even though it's like to rise a little bit, probably not too much. GDP's picked up a little bit, definitely still soft, but forecast to rise a bit further. Real income growth is coming back. Savings are starting to pick up a little bit as well, suggesting that households aren't having to cope with a cost of living crisis as well as really high debt servicing costs as well. So all those things are looking fairly positive to me, although it's going to be a gradual improvement. No doubt the cash rate is going to be on top of most people's minds, right? We've got a cash rate of 3.85% at the moment. Depending on who you follow for your forecasts, we could see anything from, say, 3.1% by the end of the year to 3.35% as a cash rate. The RBA, in the latest statement of monetary policy, had a 3.4% cash rate as their basically working assumptions, which I'd presume is a 3.35 rounded up, and then dropping back to 3.2% by the middle of next year. But financial markets are a little bit more aggressive here. We're seeing financial markets basically putting a 3.1% or having a 3.1% cash rate by the year's end, but holding there for the forecast horizon. Most of the big banks have either 3 or 4 rate cuts penciled in, sort of between now and early February. So that's kind of getting down to that low 3s or high 2s, which it sounds like a big movement, but that's generally getting a cash rate back to a fairly neutral setting. There's a lot of vagary in what a neutral cash rate setting is. It's probably somewhere between like 2.9 and the early 3s. So even with a cash rate that's getting down that low 3 or high 2% range, it's not really moving into stimulatory territory all that much. The inflation trend is all important, right? And it's great to see the RBA is a lot more comfortable with where core inflation is going. You can see the headline numbers. I mean, the quarterly graph off to the right here tracks headline inflation, which has been jumping around all over the place, partly due to things like cost of living relief and energy rebates. Massive increase in energy costs through the final quarter of last year, simply as energy rebates expired. But the key one to watch here is the trimmed mean. Core inflation down to 2.9% in March. The RBA has that sitting at 2.6% by the middle of the year, so about now, and holding there out through the next 2 years. So pretty much bang in the middle of their target range of 2 to 3%. So that definitely opens the door for more rate cuts. If the RBA was feeling less optimistic about where inflation was heading, I think we'd be seeing a very different message and a very different viewpoint from economic forecasts. One of the sticking points on bringing rates down further, of course, is the fact that labour markets are still really tight. But there is a lot of discussion here whether or not such a low unemployment rate is an indicator of a jobs market that's beyond capacity. The fact that we've seen unemployment holding at around that early 4% range for a number of years now, a couple of years, yet we haven't really seen a blowout in wages growth, suggests that a sort of a full rate of employment might be in the low fours. The RBA again has unemployment getting up to 4.3% by the end of the year and sort of holding there until the middle of 2027. So when you consider the 10-year average is about a 5% unemployment rate, we should expect that even if labour markets gradually loosen up a little bit, we are still in for a very tight labour market. Underemployment's quite low, unemployment rates quite low, participation rates are generally around record highs. Jobs growth is tracking relatively healthily. The multiple job rate is almost at record highs as well. The number of people that have more than one job. It's come down a little bit as inflation's come down as well. And then you've got GDP, right? Definitely not shooting the lights out, but definitely an improvement. When you look at the headline GDP numbers, we did see another per capita GDP drop through the March quarter of this year. But overall, a 1.3% GDP growth rate over the year, that's pretty mild. The RBA expects that to lift to about 2% by the end of the year, and again hold there for a couple of years. So it's certainly a fairly mild economic growth environment, which is still up in the air. A big part of economic growth in Australia simply comes back to consumption. How much are people like you and me going out on spending, Tony? And that's the really hard one to know where consumption is going to go at a time when there's so much uncertainty. And we're still seeing, even though real wages growth is back into positive territory, it seems to be losing a little bit of steam as well. And then finally, you've got the, I guess, just the regulatory and the policy environment. There does seem to be a little bit of caution around household debt levels. Even though they've come down a little bit, they are still quite elevated, particularly housing-related debt, which is that black trend line, which is tracking about 135% of disposable income. So I think you'll find that regulators will be quite cautious about any sort of rise in household debt levels. Could be met with a bit of jawboning from the RBA or APRA, and if it rises more materially, that's where you could see some sort of a policy response shining through. And on that note, credit policy, at least from the major ADIs, is still really conservative. And I know these numbers don't really apply to Bluestone in a sense you're not an ADI, but the broader lending market is very risk averse. Seeing generally interest-only lending holding around that sort of 18 to 20% mark. These numbers were just updated, by the way, so I didn't have a chance to update to the March quarter. Interest-only lending dropped back a bit to about 18%. High LTI and high DTI lending, you can see, is really contained, especially when you compare it back to, say, 2021 and 22 levels. Simply means that lenders are quite cautious about lending on to borrowers either with a high loan relative to their incomes or a high debt level relative to their incomes. That tends to impact on investors quite a bit. And then you can also see high LVR lending as well is really contained, especially for investors. A little bit higher over the past 4 quarters for owner occupiers. That's just a bit of an uptick in first home buyers, as well as things like some of the government incentives around low deposit guarantees and so forth as well. So yeah, overall, Tony, I think even though we're in a marketplace or an environment where we're once again seeing housing values rising, and there seems to be some underlying demand in the marketplace, because of all these factors that are still relatively tame and maybe limiting the level of transactional activity, we're not really expecting the market to move back into a significant rate of value growth. I think that a reasonable expectation is we'll see housing values at a macro level rise somewhere between maybe 6 to 8% this year. That's roughly the same as what we saw over the past calendar year. In fact, a little bit higher than that, but certainly well below what we saw in 2023. And then, of course, back in the pandemic when the market was extraordinarily strong.
We haven't specifically touched on the rental market, but be keen just to get your thoughts. We read that it softened a little bit. Do we expect that to continue, or what are you seeing there?
Yeah, the rental market is fascinating. We're still seeing vacancy rates that are well below what you describe as normal across every capital city, across every regional market as well. So typically vacancy rates are around that sort of mid 1% range. Healthy would be probably closer to 3%. But despite such really tight vacancies, we're seeing this ongoing slowdown in rental growth. So we haven't seen rents rising, at least on an annual basis, this slowly since early 2021. Um, a lot of that slowdown's occurring in some of the large capital city apartment markets. That's simply a factor of, we talked about earlier on, Tony, the slowdown in net overseas migration is taking a lot of heat out of the demand side of the equation for renters. But also, we are seeing some structural changes in rental demand. So, larger households, as group households reform and multi-generational households become more common, I think that's simply a symptom of rental affordability. Typical renters dedicating about a third of their pre-tax income to paying rent. It's pretty hard to see rents rising to a higher proportion of incomes than that. So that's seeing more group households forming, so larger households help to de-amplify rental demand. And then you've got this ongoing slowdown in net overseas migration that in itself takes some heat out of rental growth. But yeah, it's hard to see rents going backwards, Tony, I think, until vacancies start to pick up. And of course, vacancies aren't likely to pick up unless we really start to see a substantial rise in investment activity, which, maybe that's going to happen. Investors tend to chase capital gains. But as I mentioned on some of those lending metrics, if you've got a high debt to income ratio as an investor with maybe a bit of a portfolio of dwellings, it's going to be pretty hard to obtain finance, at least with an ADI.
Excellent, thank you. We do have some questions from participants today. The first one is hearing property crash rumors in the US. Do you have any thoughts or facts on that? And if that were to be the case, what should we expect here in Australia?
Yeah, great question. And yeah, I'm definitely hearing some murmurings, and certainly nothing like what we're seeing in the lead up to the GFC, for example, where you might remember leading into 2008, the US market had gone through an absolute boom of housing value growth as well as construction activity. We're certainly not seeing the same sort of lead up into the US market now. Sure that there is some upwards pressure on prices, but nothing too extreme, and we're not seeing an overbuild either. I think a lot of these, the concern about the US market probably comes more back to, the risk of higher inflation amid tariff conversations, generally low sentiment, and of course just the uncertainty related to global geopolitical risk as well. My guess is, considering most US borrowers are going to be on a 30-year fixed rate loan, we haven't really seen the flow through of lower rates impacting on the market like it does here in Australia. We have a fairly immediate influence from cash rate changes in the US, whereas in the US, it's much more muted and it tends to impact much more on things like refi activity as well. So overall, I'm definitely not an expert on the US market. Of course, we do have our US economist Selma Hepp, who publishes some excellent material. Could recommend you have a look at the US Cotality website. But yeah, I think those risks might be a little bit overplayed. And if we did see interest rates coming down a little bit further in that market, then gradually that would have to shine through to supporting purchasing activity, despite some of the fluctuations in confidence and maybe some upwards risk for inflation.
Another one from the audience. So, given that Australia has had housing issues in the early 1972, then 1990, the dot-com bubble, then 2008 with the GFC, it seems every generation we have a big housing adjustment. It's been 18 years since the GFC. Are we about due for that?
Yeah, well, each of those examples, I wouldn't say that they've been a significant adjustment. It's pretty rare to see Australian housing values fall by more than sort of 10 to 15% from peak to trough. The GFC was pretty short and sharp. Sure, we actually saw a larger decline in Australian housing values through the period of credit tightening, which was the Royal Commission and a couple of rounds of macroprudential. So 2017 to 2019. was a larger fall in values than the GFC, mostly because we didn't see a lifeline thrown to the market like stimulus we saw through the global financial crisis. Again, as interest rates started to rise in the middle of 2022, we saw a pretty short and sharp decline, but very low supply levels were a bit of a savior for larger declines in the housing market. So no, I don't think we're overdue for an adjustment in housing prices, but absolutely, as I mentioned earlier on, we do have a very unaffordable housing market, and I think probably a good outcome would be that housing values actually just stabilized for a period of time, at least relative to incomes. Let incomes grow more so than what housing values do, helping to restore some of that balance. That's generally what we've seen in the past. A good market example would be Sydney, following that significant rise in Sydney housing values between 2000 and 2003. Sydney virtually sort of flatlined for the next 5 or 6 years, up until 2009, when there was a lot of stimulus coming through the GFC, and then went into a strong growth phase in 2012. So yeah, overall, my view on sort of significant declines, you'd probably have to see a real weakness emerging in the labour markets. You have to see arrears a lot higher, maybe a real pickup in construction activity for a more significant decline in housing values to occur. I think a more realistic scenario is probably one of a more moderate, sustainable rate of growth as housing supply remains low, and then gradually we will see a supply response once we get through this bulge of infrastructure projects, and supply hopefully supported by stronger labour markets in the construction space. There is absolutely going to be a supply response. It's just still a long way away, unfortunately.
Interesting one for me here. Do you see if the government's proposed unrealised capital gains tax gets through, will that have any impact, or is it that small that it's just it'll go through to the keeper?
I don't think it'll have an impact on the MacRae numbers, Tony. I mean, from a personal perspective, I'm well away from the $3 million superannuation limit. So, but there's going to be a microcosm of people that are going to be responding to, if it gets up, these sort of changes in superannuation. Like one outcome for the housing market could be that we start to see more capital flowing into the prestige market. If you want to sort of reduce some capital from your superannuation fund, invest it in your principal place of residence, which is a bit of a tax haven, upgrade, downsize, whatever, into something quite palatial, then that might be an option. It could fuel premium housing markets to some extent. Another example could be, some earlier gifting of capital from high net worths to the kids to help them into the property market. I mean, indirectly, it's hard to measure, but you'd have to think that's already happening to some extent in markets like Sydney that are extraordinarily unaffordable, and there's a lot of equity that's been accrued in that market as well. So yeah, long story short, I don't think it would have an impact on the headline numbers or the macro markets, but there'd have to be a few niches there where some capital might be flowing into prestige markets or into the next generation, as we see some the banker mum and dad helping out.
Yeah. Interesting one here is your views on NDIS properties and where they may go in the future.
Yeah, that's a hard one. I don't really follow the policy or the impact on housing markets. I mean, from an investment perspective, I think from what I'm hearing, that there's been a lot of I suppose, demand flowing into NDIS properties because there's a guaranteed rental scheme and maybe a slightly better yield to be had. But yeah, overall, I'd probably have to refresh myself on where that policy is heading and what the outcomes might be. So I might take that one as a bit of a homework question, Tony, if that's okay.
Yeah, no, sure. We might take it offline because it's always an interesting one from a lending perspective as well. And is it a niche play, or is it just minor amendments that and therefore a great investment? So let's pick that up at a later date. Um, Another question about regional New South Wales and markets such as Orange, Mudgee, Taree, Tamworth, and how they're tracking and how you see them moving in the future.
Yeah, they've been really strong markets. I don't have the actual numbers in front of me, but if I can use some loose language here, they've generally been very strong markets. I mentioned some of those best performing regional markets a bit earlier on in the presentation, which they're not up in the sort of 20% plus growth rates over the past year. The last time I was looking at a lot of those more, I guess, rural and agricultural markets, they do tend to have a bit of a lifestyle element to them as well, which really attracts the tree changes. They have generally a pretty decent economy for local businesses, and they've got an affordability advantage in many ways as well. So yeah, the last time I looked at the trends around not just regional New South Wales, but a lot of the regional markets that tend to be more agricultural around the country, they tend to be performing pretty well. Not making the top 30, but probably not too far off it.
We always get a lot of questions about the Gold Coast. What's the thinking on Gold Coast and growth and development there?
Yeah, I mean the Gold Coast is a bit of a volatile market, to be fair, but at the moment it's just going up and up, right? It's a market that's really benefiting from strong internal migration rates. It did go through a period of not a great deal of construction activity. That seems to be picking up a little bit. There are some pretty decent unit projects going ahead on that market as well. Seems to be quite popular with lifestyle changes as well, particularly sea changes. And of course, you've got the Olympics coming up as well, which the Gold Coast, Sunshine Coast, Southeast Queensland overall will really benefit from. So even though we're not seeing values on the Gold Coast rising anywhere near as quickly as they were back in, say, the pandemic, they are still rising. They're reaching new record highs from month to month. Affordability probably isn't as much of a concern in that market, given there's a lot of capital coming across the borders as we see internal migration sort of favouring those Southeast Queensland regional coastal markets.
One from participants, but also I'm keen to understand because Bluestone will be entering into the commercial property space in the second half of this year. Good to get your views on what's happening in that market, particularly industrial unit supply and demand.
Yeah, definitely not my forte, Tony. I'm a residential analyst, so I'll talk a little bit from an unqualified perspective. So maybe a bit more anecdotal. And I definitely recommend having a look at some of the major real estate groups like your Knight Franks and Colliers, CBRE, and so forth. Do some great research into the commercial markets. So I think industrial really does stand out as the shining star in non-residential. I mean, these are low maintenance styles of investment. They tend to have generally high capital costs now, given the growth that segment of the market's seen, but they also generally have shown pretty good yields as well. So everything from your strata industrial warehouses through to massive hard stand logistical warehousing have all been very strong. And then you've got go into something like retail. You know, that's generally been through a bit of pain. I think suburban strip retail has actually done a little bit better over the past couple of years than inner city retail. But retail does seem to be coming back a little bit. And then, of course, you've got your office market where it's really fragmented. If you look at, say, your premium and A grade CBD office markets, they're still really tight. They're still attracting premium rents. It's when you get down into the lower grade styles of stock, your B, C, D grade, where vacancy rates tend to be quite a bit higher. It seems there's been a real flight to quality as we've seen a lot more people working from home and maybe not as much space requirements, as well as some new projects coming out of the ground as well. It's those premium and A grade buildings that really do seem to be standing out, which I mean poses a question of if this is a long-term structural change, what do we do with that secondary and tertiary style of office stock that's really struggling to attract tenants? A lot of people have suggested they should be converted. That's not straightforward, that's for sure. They generally don't fit a typical residential footprint or structural sort of a the plumbing's in the wrong spaces, very wide open areas. So they don't generally fit a refurb cost efficiently. So even though there's some good examples of that, I wouldn't be surprised if they're more sort of knockdown rebuild opportunities in some of those office markets.
Excellent. Well, Tim, as always, we've run out of time again. We could keep going for ages, but I'll just remind participants that we will post a copy of today's webinar, and you will get one CPD point for attending, which you'll receive after this webinar. Tim, as always, it's a great pleasure to catch up, and always insightful. And to get your views in these really interesting times. So thank you again for supporting our webinar and supporting Bluestone as you always do. It's fabulous to see you again.
Many thanks, Tony. It's always a pleasure, mate. See you next time.
And thanks to everyone that joined us today. We look forward to catching up in the near future, and certainly seeing you at the next Bluestone Cotality webinar. Thanks, everyone, and we'll see you soon.